Well, hello members. It is the end of June. This is the weekly review. We look at everything that took place the past week. And speaking of what took place, we saw some losses finally come back into this market. Now, actually, it's not so much finally came back in. I mean, if you think about it, you had a nice big spike up 4 weeks back, then down, then back up, and now down. So it's kind of been chopping up here at the top on all of the indexes, but especially on the listed issues, the S&P. Gold trades higher, as do bonds. Although the junk bonds sold off, I have a chart on that. We'll look at that. Dollar is pretty much flat. If we take a look at what's happening in those junk bonds, and I've got it on a daily time frame here, but it may be a warning flag. You had a swing point high, got over it here, right? Came back to test, held, tried to regenerate, didn't quite get going. Now we came back and now have actually broken underneath this swing point low and under the retest region. And so what was up, now sideways at best, potentially down. Corporate debt, even the Fed is buying this, creating artificial demand. It's heavy, and that could be a problem, maybe a warning flag for us. If we look at the stock indexes themselves, sometimes I take and pull up the equal weighted stocks, the RSP. It gives us a better indication of what's happening across all stocks instead of just the weighted ones. And it's here, we have a very different picture. We did get up on that big move to the top side, right? We got over these swing point lows, the retest regions. That made it look very much bullish. The ABCD we've been seeing everywhere else on the weekly is here as well. The problem is now this has pushed back into this high volume, wide price spread swing point. And if you get about a third of the way deep, right, then that portrays that you try to go to the bottom of it. And that bottom of it is 2/3 of the way back down. So this looks to be breaking back lower, and this is a negative as well. If we look at the weighted indexes, of course, we don't see that. We've seen a steady rise. The ABCD structure points way up here. But we've seen that chop that we were talking about at the top of the show. That is continuing, and we'll see if it can get back into that same bar that we were just looking at on the non-weighted. If we do, that would definitely be a negative as well. Okay, so as you know, we've been talking about this capitulation thesis, and essentially I was talking about the swing point high up here at the top. This day we called it out and said, you know what, maybe this is a blow-off type top, and we got one more day of follow-through. That was a Friday. On a Monday we got follow-through, then we chopped for 2 more days, and then the big drop. Since then we've been trying to get back up and fill this gap and have been unable to do so, and that has set up kind of a rollover that's taking place. So you come down, you roll back over, and I can't remember his name now, but there was a person I used to listen to. He always talked about this as kind of an H. It looks like an H, right? You roll over, bounce. It's the failed bounce that we talk about. And we're right back at that 2999 number, which is here. A close underneath that pushes us into the swing point high most likely. The target on this ABCD down is 2894, which is just underneath the swing point high, so that would be a break of that retest region. But it would also be a break of this swing point low and this one as well. So that's going to be a fairly fast move to the downside if in fact that happens. I'm expecting that to happen now. I think that the betting on the lower prices now is a better bet, right? It's looking better and better. And so this is looking to actually take place. I've been betting that way, as I've been telling you for a while now. The lower projection is 2894. If this really gets a move, though, we could see it fade all the way back down to this 2800 area. So this could be a fairly fast escalation to the downside. Now, I think this is worst case. and that we will see a bounce off of that. And the reason I say that, part of the reason I say that is if you look at our cap-weighted bullish bearish trends, we're seeing the bullish coming back down to the buy zone and the bearish coming up to the buy zone as well, so that you would want to flip around and get buy, you'd want to get long as you get down to this area. And so this chop that's been taking place has allowed this to roll over and come back down. And if you look at it from a sense of overbought, oversold, it takes out that overbought condition and makes it oversold. And so that is a positive for the buyers to come back into this thing and start buying it on the next leg down. The other thing is, if you look over at tech, tech has been what's held this thing up. On the NASDAQ, 9685 is the number on a daily time frame, 9846 on the NDX on a daily time frame. This is within a stone's throw of that number. Looks like it is going to break and push down towards these lower levels. Same thing on the NASDAQ, a little bit higher up, but still could get there easily. If we look at projections, go to the weekly charts, that 92.23 to 95 area. On the NASDAQ NDX, 94 down to 92. So those are the projections. It looks like these are going to roll over as well. Even though you had higher highs on these, right? These higher highs, those higher highs turned out to be failures, and they just sucked in the players on the way up. Bottom line here is the odds now favor a continuation push to the downside, and that capitulation thesis, right, that we've talked about for 2 weeks looks to be closer and closer to actually being proved true. That's probably going to give us a faster move down. If we do see a fast move down, I think worst case about 4%, 2 to 5% on the NDX NASDAQ. So there is the possibility for that push to the downside, and actually, let me take that back, not worst case, but the projection case is those levels. If we get worst case, I would expect about 10% back down from here. That's a pretty good push to the downside if it happens. If we turn our attention real quick, I'm going to flip through some fundamental charts. Did a little bit of work on the fundamental side this week. If we look at what the Fed is doing, and I pointed this out probably a month ago and said, what, the Fed's going to try to prevent massive bankruptcies. The thing that separates a recession from a depression is when you have a massive number of bankruptcies. And so the current projections project up to about here is about 50,000 on the bankruptcies, and right now we're pushing at about 25. The question is will the Fed be able to keep this into a number that makes sense? You can see back at the 2009-2010 peak, that recession back then, which really was from about 2008 to about 2009, that recession got up to about 60,000. So if the Fed keeps it to 60,000 or less, we're just doing another recession. If it keeps it to less than 50,000 or so, which is this projection right now, then that would be just a recession, not a major recession. So right now the Fed's doing everything it can to prevent these massive amounts of bankruptcies, and we'll see if that continues to be true. On the fundamentals, debt levels, we've got this corporate debt that just keeps rising. And the reason it's rising is these companies are going to have to borrow to stay afloat. Many of them need to borrow to stay afloat. And this level of exponential rise, it's not sustainable. At some point, you got to pay down the debt. And right now, for the last, 25, 30 years, it's just up, 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 and it continues to be up. And at some point, this can't continue. I don't know if it's here. All I know is this is a problem, and now we're escalating even faster. If we look at those debt levels in corporations, what does it do? Well, because of what the Fed keeps doing, it creates these things called zombie companies, right? And now roughly 18, almost 19% of the companies out there for 1990, this chart, 20, so roughly 20, 1 in 5 companies are zombies. And what is a zombie? It's a company where the debt servicing, how much it costs to service the debt, is higher than the amount of profits they take in. So how do they make it work? How do they stay alive? They borrow, right? They just keep borrowing. When you have zombie companies, it's a drain on the economy, and that's what we've created. And this plays into the whole idea that GDP cannot rise as it should or has in the past because these companies aren't producing enough to let it rise. This pushes us, if you think about it, it pushes the whole economy, right? The whole country towards being a zombie country. We just create more and more debt, so our net liability to assets just keeps expanding, right? The difference from here to here is there, compared to what it used to be. And so when you have this situation, right, all it does is make things worse. And right now we're going into some sort of a deep recession, and that is going to create even more problems for these zombies. Either they're going to have to borrow more and the Fed's are going to have to prop up those markets and those companies, or they're going to get crushed and they're going to go bankrupt, and we're going to have to see massive bankruptcies. And so, it's a vicious cycle that's playing out. And that cycle, it's potentially going to end now when this happens and we start crushing these companies, or we're going to just force it to continue, and it's just going to get worse down the road. So I don't know which way it's going to play. Can the Fed keep it alive, or does it just overwhelm the Fed? It's hard to believe anything's going to overwhelm this Fed because they seem to be intent on financing everything. But at some point, you can't finance everything. At some point, you've got to let something fail, and maybe there will be some realization of that need at some point, but so far we haven't seen it. The higher debt, why is it a problem? Because it's lower GDP, right? The more the debt load goes up and the more these zombie companies are created, the lower the GDP becomes, and that itself is a huge problem. This is a definition off of Investopia. You can go read it for yourself, but essentially, more debt you got, less GDP you got. And it's not like we're going to solve this by exports, right? All of our trading between all of our partners is collapsing, right? We had this huge run up. Trump gets elected, we get a huge run up. A big piece of this from about right here up was the idea that we were going to do tariffs, especially against China, and so you had pulling. Those countries that were exporting, they exported as fast as they could to escape those tariffs. The companies that were imported ahead of the tariffs so they didn't have to pay them. That drove this number higher, and then we've been going lower ever since. And if you notice, we're almost back to 2014 levels in terms of trade with all partners. If you look at just China signed a trade deal, right? A trade deal that says we're going to import a bunch more of your stuff. Well, it's not happening. You can especially see that over here. This is it's kind of small, but this is the DBA monthly chart, and it's just down, 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 right? Last 4 years, just total failure to pick up any kind of increased sales, primarily to who? To China. And so China's imports not showing anything that this trade deal has actually done anything. It looks to me like this whole trade deal ends up being a bust. And so it's certainly not with China that we're going to pick up trade, and we're not doing it with the rest of the countries. And therefore, I don't see trade taking us out of this deficit situation. So we're not going to grow our way out of debt either. If you look at unemployment, unemployment, as you know, extremely high. We're pushing 15% in the latest numbers. People are expecting this to get up to 2025. This is worse than the soup lines. This is the worst it has been since the soup lines back in the Great Depression. Here's the 2009, 1982. I've lived long enough to see that one. That was a bad time too, but this dwarfs everything. What drove these layoffs? Well, COVID, right? When we shut down the economy. And if you look at those numbers, this exponential rise is starting to take place again, just like it did back here. And so if we look at this, and the problem is now we don't have lockdowns in effect, but it looks like we're going to be forced into slowing down in some ways, at least in some of these states that are showing the huge rises. Texas and Florida. Arizona is doing the same thing, although Arizona hasn't began to slow anything. We're starting to reverse and actually shut down bars as of late last week. They're going to shut down the beaches in Florida this weekend. All of this is going to hamper any type of recovery. And remember, this entire March higher is based on the V recovery, right? So you got a V-shaped recovery in the markets based on a V-shaped expectation recovery in the real economy. Ain't going to happen. I've been saying it for a long time. It's not going to happen. And it wouldn't happen even if this didn't go shooting back to the moon. Even if it just stayed at an elevated level, we wouldn't have got back. Because the fear of going out in a large percentage of the population is too great. Right? The fear of catching this is too great. And it's well-founded fear, in my opinion, because the devastation of catching this is significant. And until we get proven treatments or until we get a vaccine, or, those two things, one or the other, right? This isn't going to change, and this whole economy just can't recover. Yeah, we can mope our way around, but we're not going to get back to where we were. And remember, a long time ago, it was probably a month and a half ago, I said if our demand level was here and we dropped down to here, when we recover, maybe we get 80%, maybe we get 90%, but we're not going to get back to where we were. It's just not going to happen. We're certainly not going to go above it. Maybe we're up about 80% total right now. But now with this happening, you're going to see this probably tail back down. So in summary, on the fundamental side, it's bleak, right? The debt's surging, exports are plunging, the unemployment rise looks to be more permanent than people expect. And the COVID cases, which have driven all this, they're surging. We're heading in the wrong direction. It doesn't look to me like this is going to change anytime soon. Earnings are out in 2 weeks. They're going to be horrible. I don't know that they're going to get sold off the stocks as a result of that because there's no projections in the future right now. About 60% of the companies said, you know what, things are so messed up, we can't even tell you what's going to happen. I expect this number to be as the same or higher. More and more companies aren't going to give us forward guidance. I don't know if that's really going to be affecting prices or not. We'll have to see how they react. But it's not a positive, right, when you can't say what the future holds. Okay, moving to the prognostication. Last week we were spot on with the most likely scenario. Expectations this week, best case, I think you get back to these highs, but I think that's the low runner case. The most likely case, and I expect this is going to happen, is they're going to go down. We're going to finish off that ABCD projection, right? I suspect that's what we're going to see. Worst case, we just tumble and we go down to 2,800. It's going to be holiday shortened, nothing on Friday, so it's going to happen fast and furious if it does. That's it for this week. Have yourself a great one. Stay safe, folks. I'll see you next time. Take care.